key concept for most consumers to keep in mind is that there are two sides to every trade. Both parties are betting that they are right, but obviously only one of them can prevail. For instance, when you buy a CD for a term of, let's say, 2 years, you are betting that interest rates will remain the same or will fall. In other words, you are making a projection that the rate you are locking in today will still look pretty competitive in a couple of years. Otherwise, you would buy either a shorter term or a floating rate savings vehicle. The bank, on the other hand, is taking the other side of the trade. They're hoping to keep their cost of funds low over the next 2 years so that they can lend your funds out at a rising interest rate margin. The Fed is making this kind of bet with consumers. However, it may not be working as well as they expected. The Fed has driven interest rates down to next to zero in order to push people out of savings vehicles and into risk assets such as stocks. The thought is that rising portfolio values would make people feel wealthier and more prone to spend some of their wealth. The other side of that trade is that they have wiped out any interest that savers could earn. So in effect, the Fed has punished the people who saved in order to bail out the people who took on too much debt. Part of the reason that the economy remains so soft is that we are missing the spending of many savers. Further, super low interest rates like we have today only encourage people to take on more debt. The benefits of low interest rates definitely come at a cost. Savers now have to consume their principal in order to survive. It doesn't seem right, but that's the way it is. I'm Tony Ogorek.